I'm sure you know somebody that refinanced last year. Rates were super low, but did you know 78% of homeowners actually did not refinance? So 78%, that's who I'm talking to right now. I'm sure you're kicking yourself for not refinancing then, but it still could be worth looking at today, even with higher interest rates. Let's look at the numbers. So let's assume that you purchased 3 years ago, mid-2019. In South Texas, the median price then was $269. The median price now is $362. So it's safe to assume that if you purchased then at $269, your home is probably worth $362 now. Average rate then was 4.5%. Average rate right now to do a refi cash out on a primary is about 5.875%. Those are the numbers that I'm using. So your payment on the current mortgage at the $269,000 purchase price and 4.5% interest should be about $1,380 with a small mortgage insurance premium. So if we did a refi cash out and we tapped into the max amount of equity that we could with a value of $362,000 and an interest rate of 5.875, your new payment would actually be close to about $1,715. So it's about a $330 payment increase. You're saying, why on earth would I refinance to have a higher interest rate and a higher payment? Well, let me show you. So in that scenario, when we're tapping into the max amount of equity, that could potentially put about $40,000 in your pocket after we pay off your current mortgage and after we pay all the closing costs. $40,000 goes back to you. What could you do with that $40,000? You could invest it in real estate, and let me tell you why. So the last 2 years, real estate has appreciated about 26%. I know the last 2 years are kind of weird, so let's look back further. 5 years is about 49%, and 10 years ago was 99% increase. And that means the home values have doubled in the past 10 years. Now, if we're also looking at the increase in payment and how much you're actually getting, it would take about 10 years for it to be washed. It's 9.6 years really. But if you only took the money that you received, the $40,000, and made the additional increase in payment, the $330, it would take 9.6 years for you to run out of money. So that's your break-even point. So 10 years is very important. So if you were to take this $40,000, invest it in real estate, buy an asset that's worth $200,000 now, in 10 years, your break-even point, that home could potentially be worth $400,000. We're not talking about just doubling the money that you're investing, we're doubling the value in all. So that $330 a month increase could potentially net you $160,000 in equity.